Hi, my name is Rachel Matthew. I'm a tax attorney and partner at Polston Tax, and over the years I have done hundreds of presentations, but this one that I'm going to present on is different from all of those, and it's frankly one of my favorites because it looks at accounting and taxes in a completely different way. It was inspired by a movie I recently watched called The Accountant, starring Ben Affleck. And if you haven't seen the movie, it's perfectly all right. That's not going to be the point of this presentation, and I'll quickly run through the plot so you get an idea of what inspired this presentation. So I'm going to be teaching you taxes and accounting through examining this movie, but also just going over what do you do if you have money that's been illegally gained or fraudulently, or if you've embezzled money. You may not know all of this income must be reported on your tax return on the field for other income. So there you go, there's your first tip. Let's get right to it. So this movie called The Accountant, it featured Ben Affleck and Anna Kendrick. And the plot was that Ben Affleck played this individual named Christian Wolf, who is a mathematics savant with an affinity for numbers. He used a small town CPA office as a cover, but he makes his living as a freelance accountant for criminal organizations. In this movie, there's a treasury agent who's pursuing him, and Christian decides to represent a legitimate business and takes on this state-of-the-art robotics company as a client. But as he uncovers the truth about a discrepancy in their accounting involving millions of dollars, people start to die, like any good movie. And so I was really inspired by this movie, which does focus on accounting and its role in business. And I thought I would examine some facts and fiction about tax returns and accounting, and then look at different ways that accounting is used to pull off crimes. Fact or fiction? This one gets tossed around a lot. 50% of taxpayers are not required to file a tax return. One of the opening scenes in this movie is this elderly couple that Christian, Ben Affleck, is helping to prepare their tax return for, and it made me think of this statistic. 50% of taxpayers are not required to file a tax return. I wanted to clarify that. So the IRS requires that every citizen of the United States must file a tax return if they earned more income than certain thresholds that the IRS has set. Not every citizen of the United States is required to file a tax return if they earned less income than certain thresholds. Now, I made those two statements because they actually say the same thing. Sometimes people, depending on what they're trying to push, will say not every citizen of the United States is required to file a tax return, or 50% of taxpayers are not required to file a tax return, or the IRS requires that every citizen of the United States file a tax return if they earn more than certain thresholds. Both of those statements are true, and I wanted to make that point up front because this is how facts work. Facts can be stated using words in context to make them sound a certain way. And although the fact may be true, it may be used to lead you to believe something or be upset about something, even though restating that same fact may lead you to feel a different way about the same topic. I mention that up front because sometimes accounting, taxes in particular, is a hot button issue, and I see it all the time, and I wanted to make that point about facts. Fact or fiction? 44% of taxpayers pay no income taxes. Now, first I'm going to say this is sort of true. 44% of taxpayers pay no income taxes. The Tax Policy Center had calculated that about 44% of taxpayers do not pay income tax. Here's what I want you to note about that: the word income. So that percentage is estimated to be true, but it's only on something called income taxes, which are different than payroll taxes, which are taken out of paychecks. One thing that people seem to believe about this statistic is this is made up of entitled takers living off the system. Are they living on welfare and taking advantage of government benefits while the rest of us work hard to pay the taxes for everyone? I wanted to break down who those 44% are that don't pay income taxes. And again, be sure to note the word income. The 40% are typically very young people between the ages of 16 to 24 years old, or they are very old, age 75 and up. Of those who are prime working age, 1/3 will not pay taxes for only 1 year. 3/5 will not pay taxes for up to 3 consecutive years, and 1/8 will not pay income tax for 10 years or more. So a small percentage of individuals in that 44% are actually of prime working age and are not paying their income taxes. Of those not paying income taxes, we find that most are low-income households. Women may work and pay income tax until they have a child, but then may stop working because the child care costs are as much or greater than their income, and thus they're no longer paying income taxes because they've stopped working. And low-income workers also frequently face layoffs or participate in seasonal jobs or other intermittent odd work. So of the low-income households, often when women have children, they stop working because their income is so low that they can't afford the childcare costs. Or also, the low-income household is some kind of intermittent job, a seasonal job, odd work, or low-income households often face layoffs because of the nature of the work. Also, we can break down the retirees not paying federal income tax. Retirees actually make up about half of the total of people not paying federal income taxes. These individuals who paid taxes throughout their working careers may now be living on Social Security income, and Social Security income below $25,000 is excluded from their adjusted gross income, which is a benefit that they have earned. Half of those 65 years and older receive Social Security benefits of $15,000 or less per year. So we're not talking about extravagant living and not paying your taxes for those individuals. Fact or fiction, the top 20% of Americans pay almost 90% of all federal income taxes. First, again, the statistic only refers to federal income taxes. Both the federal part of that sentence and the income part of that statistic are important. About 1/3 of all taxes come from payroll taxes, which in fact falls more heavily on working class people because it is taxed only against the first $130,000 of earned income. So somebody making $1 million still only gets taxed payroll taxes on that first $130,000 of income, while someone making $80,000 gets taxed payroll taxes on all $80,000 of that income, up to $130,000 annually of income. I use this example: a nurse making a salary of $50,000 per year pays, counting both the employee and employer side, 12.4% in OASDI taxes for Social Security and disability insurance, but sitcom star making $50 million a year will pay the 12.4% only on the initial $130,000 of their salary, working out to a total OASDI tax rate of just 0.03% on their $50 million. OASDI taxes are also only taxed on earned income, meaning you make money from a job. A billionaire investor with a $50 million annual income from dividends and capital gains will pay 0% in OASDI taxes. Fact or fiction? The wealthy pay more total taxes. And here's another one of those statements that is true, but you have to consider why it's true. The wealthy naturally pay a disproportionate share of federal income taxes because they make a disproportionate share of the country's income. Or in other words, this is not an indication that the super rich are placed with a higher burden on taxes, but instead is a sign of America's staggering wealth inequality. Because the wealthy, as a total aggregate set, make significantly more than the remaining population in America. Okay, now getting to some of the meat in this movie. Money laundering is one of the first topics I wanted to touch on, and I thought this was really interesting. It's a topic I understand, but I was curious if others understood how money laundering works. And this gets to why I thought this presentation would be maybe fun and interesting to discuss. How do you use accounting to get away with crimes? How does this exactly work? I think it's fascinating. Money laundering is a process that criminals use in an attempt to hide the illegal source of their income. By passing money through complex transfers and transactions or through a series of businesses, the money is cleaned of its illegitimate origin and made to appear as legitimate profits. Here, I'll use this picture that I used here. So we've got ZZZ Accounting. First of all, that is the name of Ben Affleck's accounting firm, ZZZ, which is interesting because if you're looking in a phone book, it's going to be the last accounting firm. Usually nobody's going to get to ZZZ. It's also not very catchy. And it'll alphabetically be placed at the end of, likely at the end of any list. So he's not trying to stand out and get a bunch of clients. He just wants to fly under the radar. The businesses that were on in this strip mall, and I can't recall if the strip mall itself was owned by ZZZ, but let's just say it was. Let's say ZZZ Accounting had built this strip mall, and I'll use this as an example of money laundering. So let's say Christian, Ben Affleck, gets millions of dollars, $50 million from a drug cartel. And he needs to somehow separate this income from how it was earned. So what he could do is undertake a construction project like this strip mall. And as the strip mall is getting built, as the foundation's laid, let's say the cost for the foundation is $100,000. Instead, he could inflate the invoice that he's paying to $300,000, and boom, now he's siphoned off $200,000 of drug money, paid it to a fake construction company, and then paid the real invoice of $100,000 to the real contractors. And so on for every step of this building project. He could inflate the cost of framing, the cost of electrical, the cost of every single piece of this. You get the picture. And that is one way to launder the money. What he may do is create a shell construction company. And then if he wants to turn around and move the money from the shell construction company to another company to purchase, let's say, a house, let's say the shell construction company then purchases a house, well, now that cash that was in the shell construction company, the overinflated costs now purchased a house and went into the bank account of the seller of the house. Well, now Christian owns a house that he can then sell and get legal funds from that sale of the house, and so on and so forth. He can buy any number of goods, other buildings, cars, jewelry, paintings, and sell those goods and then have legal cash that he can place in the bank. And here's a diagram of how dirty money is laundered, how it's cleaned. So first you get the cash. That cash can go into a bank. Then you layer it. You try to distance yourself from the crime source. You can move it from one bank account to another bank account to another bank account. Often international bank accounts are used to disguise the identity of the individuals involved. Eventually, that money can be used to purchase assets like buildings, like jewelry, like physical assets, and then those assets can be sold, and now you have legitimate cash. A major business problem of large organized criminal enterprises, such as drug smuggling operations, is that they end up with huge amounts of cash that they need to conceal in order to avoid attracting investigations by legal authorities. To deal with the problem of having millions of dollars in cash obtained from illegal activities, criminal enterprises create ways of laundering the money to obscure the illegal nature of how it's obtained. And maybe this is a topic that's not talked about often because we don't want to teach how money laundering is conducted because we don't want people to know. But frankly, I think that anyone who plans to do any one of these things that I'm going to go over could just look on the internet and find it themselves and be taking advantage of how some of these accounting pieces work and disguise their actions. I actually think it's fundamentally better for everyone to know how some of these white-collar crimes are committed, particularly for business owners and particularly for individuals in fiduciary responsibilities, so that you can be on alert for your own businesses, for your own employers, and help to detect any one of these things from occurring. And this is, just another diagram of how to launder that money like I described. Borrow against assets, getting loans against assets, it's another way to get clean money. Okay, so I touched on how the strip mall could have been built to launder money, but also the businesses in this strip mall are primarily cash businesses, and individually, each of these cash businesses could be another front for laundering money. Businesses that typically accept cash in exchange for goods or services are an excellent way to commit money laundering, like flower shops, restaurants, pawn shops, salvage shops, auto parts stores, ice cream only places, food trucks, check cashing, payday loans, convenience stores, nightclubs and bars, laundromats, nail salons, or massage parlors. Sometimes you think, gosh, nobody ever goes to this business, or how do they make money just selling cupcakes, or something like that. I'm not saying cupcake only stores are money laundering, but if you've ever thought, how do they make money? Nobody ever goes to that restaurant. I'm not saying they're money laundering. I'm saying that businesses that operate in a lot of cash are prime for money laundering. So we have ZZZ Accounting. He reported, I don't remember, a couple tens of thousands of dollars on his tax return, which is normal for an accounting firm. Then you've got Paul's Laundromat, which is next door. Laundromats are known for being a cash operation. So let's say the laundromat reflects $120,000 in cash. That may not have been truly from people doing their laundry, which would actually be funny to money launder through a laundromat. But really just you have some illegally gained or fraudulently gained money that you're trying to push through a legitimate appearing business. Same with this nail salon, massage parlor, tanning salon, facials. nails. I don't know if I mentioned nails. And then I think also on this strip in the movie, there was a restaurant. So in this way, you could push out a couple $100,000 from all of these different cash businesses in any given year. And regardless if they had any real business or not, you could make it appear that they did. You could also use the inventory of these businesses, the expenses you have to pay out, like purchasing nail polish and food and laundry supplies and washers and dryers and all these things, to expense out, like I explained, overinflate invoices to expense out cash and then move it along through this cycle. Okay, embezzlement. This one, I want anyone who is in a position of authority or trusted responsibility in your organization to pay attention. There are lots of ways that embezzling happens in businesses, and not necessarily by somebody you would suspect. Frankly, people get away with embezzlement all the time because it can happen so easily, and there are not good protections in place. Oftentimes embezzling requires coordination in order for it to occur. But one good tip I'll just give right off the bat to everyone who's listening is, if you have a CFO or an accountant who handles your accounts payable or accounts receivable, or just any individual in your organization with that singular function, I would recommend rotating accountants or rotating CFOs or rotating CPAs. Make it a rotating role, just in general in your accounting functions, to keep those positions and responsibilities divided up, and potentially even to rotate those responsibilities. It's not going to be a fail-proof plan because there could be coordination between everybody who's rotating to these different responsibilities, but it at least puts a check and balance in place to keep one person's hands out of the jar. Often we find that crimes are crimes of opportunity, like leaving your expensive goods in your car and leaving your car unlocked, or keeping the goods in visible view, things like that. Crimes of opportunity over a lot of planning and coordination. Just like we're seeing people stealing packages off of front porches. Those are just crimes of opportunity. It's there, seems easy enough, doesn't take a lot of planning and coordination to get the job done. So let's talk about embezzlement. Embezzlement takes place when a person uses funds for a different purpose than they were intended to be used. That's a basic definition. Embezzlers might create bills and receipts for activities that did not occur, and then use the money paid for personal expenses. Embezzlers may also divert customer-client payments directly to a separate bank account under their control. Embezzlement is different from fraud or larceny, which is theft. The embezzler has permission to handle the property in a certain way, but not to take it. Instead, the wrongdoer uses the position of trust granted by the owner to convert the property to the embezzler's possession and control to take it. So I'll just give you a quick example, maybe two quick examples of embezzlement. There was recently a case where the FBI took down an accountant in a small town in Illinois. It was the hometown of Ronald Reagan, and it was the largest, I want to say, embezzlement of a municipality that had ever occurred. The town had 16,000 people, I believe, and this accountant was one of 3 of the administrative roles in this town. She embezzled, and I'm going to, just off the top of my head from recalling the story, I believe it was about $53 million from this town over a career that started decades ago. And she was just caught recently, and it was the largest embezzlement and recovery by the FBI for a case of this nature. How she did it was sort of like how I explained money laundering. She was creating fictitious invoices. She had created a bank account at Fifth Third Bank, which was the bank used by the city. And she opened a bank account as the treasurer for I want to say the city of Dixon, gosh, I'm going to get the city name wrong, but for the city. But it was a fake account. It was named the city of this town, but it was a fake account. And but she spent personally out of this account to buy jewelry and whatever. Now, how did she do that? What she would do is she would create a fake capital expenditure project, like fixing roads and bridges or buying trucks or things like that. Fake expenditures, create a fake invoice, and then present this fake invoice not to the city council to approve it, but to the bank to pay it, and then the bank would move the money from their capital operating expense account or from their account to this fake account, and now she had the money. By the end of it, she was embezzling the town's entire operating budget into her personal account. And how she was using this money and paying for expensive things like multi-million-dollar personal RV is she was also a well-known equestrian rider. And she said this money was coming from those winnings. Regardless of the particulars of the story, you can see how it could happen at a large scale, as large of a scale as she did, or a small scale where it's here's an invoice for this thing and it's paid out, but really the check gets deposited in this account for an employee of the business. In this case, it was an individual who had a fiduciary responsibility to the town. Another way embezzlement could occur is because businesses operate off of thousands, if not millions of transactions, it is difficult for every penny to match up day to day. And it's difficult for any organization to keep track of their overhead and expenses paid out, their accounts receivable and accounts payable to the penny every single day. So another way embezzling can occur is by individuals taking advantage of that and siphoning off small amounts of money or reporting, let's say monthly reports that are incorrect and getting paid on profits that are fictitious. Now, in this movie, it focused specifically on Christian Wolff, Ben Affleck, coming in as to do forensic accounting. They don't feel like their numbers are matching up, and we're not talking about pennies, we're talking about millions that don't seem to make sense. And so he gets their files from decades and he wants to go through all of them to go back through, match up invoices, match up records, match up jobs, match up payroll, and all of that. Mentioning payroll, that's another good way to, I don't know if good is the right word, that's another way to embezzle, and I'll touch on that here in a second. So in this case, in all cases, what forensic accounting is forensic accounting utilizes accounting, auditing, and investigative skills to conduct an examination into the finances of an individual or business. Forensic accounting provides an accounting analysis suitable to be used in legal proceedings. Forensic accountants are trained to look beyond the numbers and deal with the business reality of a situation. Forensic accounting is frequently used in fraud and embezzlement cases to explain the nature of a financial crime in court. Now, I said there's something I want to talk about in payroll. This wasn't something that happened in the movie, but as he's looking at payroll reports and all of those types of things, it reminded me that payroll is another good way to embezzle from a company. So if you have, like I said before, it's good to rotate positions. So if you have, for example, just one person doing all the payroll, reporting all the employees, reporting all their time, reporting their time, their rate, their reimbursements, and all of that. and that responsibility falls on one person alone, it's very easy for that person to add a name to the list and have that money direct deposited into an account that they control, that the person who handles payroll controls. This could happen even if you have payroll handled by multiple people. Let's just say you have one person who is responsible for getting all the time for all the employees. And let's say, so for example, our organization has over 100 employees and they're in 6 different states, and I like to know the names of all of our employees, but if somebody told me that today they hired an employee for such and such department and they're going to be doing this specific thing and they're in this specific office that I haven't been to, I would add them to payroll just like any other employee. If I were to do this and the direct deposit information that's set up is for the bank account of the person who's fraudulently reporting this, let's say a manager of that department, well, the manager of that department now could set up a bank account for this fraudulent employee that they say is under their watch. They could report fraudulent hours for this person, and everyone doing payroll from the beginning to the end would not know that this individual does not exist. Even if they reconciled payroll against each other. So even if the individuals handling payroll are not involved, you could have some embezzlement happening. That occurs with larger companies rather than smaller companies where you're going to know the name and face of every individual and what they do and be reaching out and contacting them. Particularly when businesses get larger and everyone doesn't know everyone, they don't know what everyone does, or they may not need to, the people from payroll may not need to talk to the people who are handling some specific segment of a matter in the office. It's easy for these types of individuals to get added to payroll. Something like forensic accounting would be able to catch, you would think would be able to catch something like that. The reason I say you would think is that city I mentioned before that had that embezzlement occurring, they actually had an auditor for the town. And that audit that occurred year after year never ended up actually auditing the town. What occurred instead was that they signed off that the audit was completed, but instead it was, I believe, this accountant or the accountant in coordination with the accounting firm that handled the tax returns for the town that provided the numbers, and this independent audit was never really occurring. Instead, they were signing off as it occurring, but they were just basing it on a compilation of the numbers being provided to them by the town. That's an important distinction, a compilation versus an audit. An audit, which is also different from forensic accounting, an audit should independently verify the numbers being provided. Forensic accounting actually dives in even deeper. It's even more expensive, and it is more time intensive and investigates with more detail on every number that's reported. Forensic accounting is also used to discover whether a crime occurred and assess the likelihood of criminal intent. Such crimes may include employee theft, securities fraud, falsification of financial statement information, identity theft, or insurance fraud. I'm not going to get into all of those here, but I just listed them so you could know all the different things that can occur within an organization that forensic accounting should be able to pick up. Forensic accounting is often brought to bear in complex and high-profile financial crimes. The reason the nature of Bernie Madoff's Ponzi scheme is understood today is that forensic accountants dissected the scheme and made it understandable for the court case. In Bernie Madoff's Ponzi scheme, or in any Ponzi scheme, what occurs, for example, there is that Bernie Madoff, or anyone, in fact, I don't want to mention him specifically, anyone who is participating in a Ponzi scheme or creating one, offers to or purports to offer an investment opportunity to an individual and ask that individual to invest funds with them. After the funds are received, those funds potentially could be invested or are used for other purposes. But then the individual who is creating this Ponzi scheme will go and find another individual to invest in this opportunity. And when that person invests, they will use the second person's funds to repay a portion of the first person's funds and lead the first individual to believe that they have now received a return on their investment. And thereafter, either incite them to or incentivize them to invest more, or lead them to invite others to invest. And that pattern carries on from investor to investor, where you're taking the funds of one individual and paying it to another individual while simultaneously siphoning off cash for yourself. Forensic accountants may also assist in searching for hidden assets in divorce cases or provide their services for other civil matters such as breach of contracts, torts, disagreements relating to company acquisitions, breaches of warranty, or business valuation disputes. Forensic accounting assignments can include investigating construction claims, expropriations, property liability claims, or trademark or patent infringements. And if all that wasn't enough, forensic accounting may also be used to determine the economic results of the breach of a non-disclosure or non-compete agreement. So for example, let's say you have a non-compete agreement with an employee and they breach that agreement. A forensic accountant would be able to go in to show the harm that this breach or this other employee now competing with you has caused to the business, and they can calculate that. And that calculation can be used in court. Another way that money laundering can occur or crimes can be paid for is accepting payment via non-cash goods. That's a good way to not report your income, is receiving non-cash goods, not paying taxes on non-cash goods. Non-cash goods can be transferred to pay for other goods or services. No cash on hand or placed in bank account for easy tracing. Audits typically review only liquid cash, and IRS typically does not take an inventory of the goods owned by a taxpayer or of the contents of a safe deposit box or storage facility. And I use the word typically because sometimes they do. And what I would offer is the IRS, when they conduct an audit, what they start with first is all your bank accounts. They are going to reconcile your bank accounts and all the cash you have put in the bank against your tax return. So they'll add up all the deposits, and if your deposits for a year don't equal what income was reported on your tax return, they'll want to know more. This is one way a lot of people who are in a cash business may not put all of their cash in the bank and then not report all of their cash received as income on the tax return. That's illegal, and you are supposed to put all income earned on your tax return. But if it's where the IRS starts is by looking at your bank statements, seeing how much was deposited in the bank, and if it reconciles with your tax return, they may stop there. What may lead them to continue investigating, or if they have other reasonable cause, they may continue investigating. But what the number one thing that leads them to continue investigating is assets that they're aware of, like let's say somebody who's a CPA owning a small operation accounting firm suddenly purchases a yacht. They may ask, where did you get that money? Even if it's, especially if it's not on the tax return or deposited in the bank. Stock pricing is another thing that came up in this case, and not in this case, in this movie. I'm so used to talking about cases as an attorney but this time I'm not talking about a case. I'm talking about a movie. And stock pricing is what was behind the millions of dollars in discrepancy in the forensic accounting. So here I'll describe how stock pricing is set. So generally, the prices in the stock market are driven by supply and demand, generally. We recently saw how the short on GameStop was destroyed by a sudden demand on GameStop stock. Not because the value of GameStop or the store itself was thriving, but because the market and individuals on Reddit and otherwhere on the internet decided they were going to purchase GameStop stock and drive the stock price up because of the demand. So when a stock is sold, a buyer and seller exchange money for share ownership. The price for which the stock is purchased becomes the new market price. When a second share is sold, this price becomes the newest market price, etc. And that's where you get these fluctuations in the market. And let me just see. Now, how stock pricing is calculated. After a company goes public and its shares start trading on a stock exchange, its share price is determined by supply and demand for its shares in the market. Now, that's after it goes public. If there's a high demand for its shares, the price will increase. If the company's future growth potential doesn't look good, sellers of the stock can drive down its price. Now, that is an important point as to what happened in this movie. In this movie, they found that millions of dollars were being expensed or siphoned out of the company, and they wanted to figure out how and why. But once they identified how the money was being taken out, they discovered that it was actually also being repaid to the company through demand. So what was occurring was that they were losing millions of dollars through potentially embezzlement on the books. But that same amount of money was deposited back into the business in the form of purchases for this robotics invention, state-of-the-art new robotics invention that the company was marketing as the future of the company, and they were going to take this company public. Well, by using millions of dollars to purchase this invention and demonstrating a huge demand by the public, they actually were able to fictitiously increase the demand or artificially make it appear that there was a huge demand for this technology. And by doing so, they were going to have their stock price valuation be incredibly high, because the valuation is based on demand, not the actual expenses of the business. So, in this movie, the owner of the company embezzled money from the company through fake invoices. He injected it back into the company as sales, and the goal was to make the company look more profitable by building up gross revenue and a fictitious demand, thereby driving up the stock price. And thereby driving up the stock price. There are a number of other things that this movie doesn't quite get to, but it's So, like I said, in this movie, the owner of the company embezzled money from the company itself through fake invoices, and then he injected it back into the company as sales. The goal in this scheme was to make the company look more profitable by building up gross revenue and a fictitious demand that the owner knew was going to be what was used to determine the initial public offering or IPO of its stock price. And he wanted that stock price to be high. This can also be used by individuals trying to sell their business. It's a lesser understood way to increase a valuation of a company's value when a valuation is occurring. So sometimes the valuation used is gross revenue times so many years out. And that will tell you the sales price of the business at a very basic level. The thought on that is that any purchaser of the business is going to be able to control the expenses of the business and increase the net profit. So the net profit number isn't the driver of the sale price. But just like the stock price was inflated in this movie, so too could a valuation amount be inflated artificially before a company tries to sell a business. There are other ways that money laundering occurs. For example, casinos are a great way to launder money. Sometimes church members attempt to earmark donations to the church to go to specific funds around the world in the name of charities. This is actually against the nonprofit rules for private members of a nonprofit to earmark funds unless a specific solicitation was made by the nonprofit for those funds. It's not the members or contributors or donators to a nonprofit who are allowed to earmark the use of the funds. One reason I was especially excited to put this presentation together and to get people thinking about how accounting can be used to disguise these white-collar crimes or to get away with more serious crimes is because I think it's relevant to every business owner, every self-employed individual, and anybody who's even an employee of an organization or in a government agency or a municipality to think about how accounting can be used to cover for crimes being committed. A very simple example that doesn't take a lot of sophistication is a frontline worker taking cash from a register, for example, but then subtracting that from recorded sales for a day, or in a restaurant, for example, and just pocketing the cash altogether. A lot of this has been done away with electronic registers and electronic counting machines, but it is still occurring. Number one, I recommend you rotate accountants in an organization. Number two, that you have multiple eyes on similar accounting functions, even if that means redundancy on highly trusted employees. Even highly trusted employees and individuals with great relationships with you, with ownership, and other managers in an organization may be lured by crimes of opportunity. Or may even, I'll say this with sympathy, may even have some kind of one-time expense or need arise that they intend to pay back after they borrow the money from the organization. Just be aware of how these things can occur. Educate yourself, protect yourself, arm yourself, and above all, don't put anyone in a position of being able to get away with any of this. It can harm you, it can harm them. And it's better for everyone if you safeguard yourself, your employees, and your organization against it. If you have any questions or want to reach out to me, my email address is rachel.matthew@polstontax.com. Our number is 844-841-8675, or visit us on the web at polstontax.com. We would love to hear from you. Hope you enjoyed this.